controlled chaos, or maybe not that controlled. I think that's how we could possibly look at the world, at the United States, the economy, just kind of in general. We have this kind of almost controlled chaos. That's what I'm going to be talking about this morning. It's going to be more about the economy than it is about people, taking to the streets. In fact, we won't talk about that at all. So I'm going to start it this way. I believe there could have been, it's possible that we've had other times in history where so much of a country's economy was being completely revamped. But if there have been those kind of times in history, we haven't known in advance. I don't think in the 20s, people were going, oh, this is the craziest economy, and here's the changes that are coming, and we don't know. We're just, it's all hitting from all sides. I know it wasn't happening in the 90s. I was here. Comparisons are popping up, and the comparisons would be the 20s and the 90s and 2008. But again, 2008, I can tell you for absolute certain that very, very few people were recognizing the changes that were taking place in the housing market and the derivatives market, et cetera, that would finally turn out to create what was created. George Bush, actually, for all the people that talk negative about him, was one of the people who was ahead of that curve, but nobody paid any attention to him. But this period that we're in right now, I think it's without comparison. I'm going to go through a list of 14 things right now that are impacting these changes right now, the things that are changing that are impacting the overall picture. And I think you're going to know all 14 of them. Maybe you won't. Maybe there'll be a couple in here that are new to you or that you haven't really thought through. But I think also just saying them out loud and all at once is a good exercise before we get into the impact. What's going to happen? Are we going to have a huge, massive hit to the equity markets? Are we going to see gold continue to go through the roof? Anyway, we'll talk about what might be the impact, but let's first of all talk about what we're dealing with. Number one, we have the highest debt to GDP ratio in peacetime ever. This is not new. It's been around for a few years now, but it's gotten worse. And maybe we're turning the corner, but it is still an issue. And many people for quite a long time have been, yelling and screaming that this is going to be our undoing. Number two, we have a deficit, which is over 6% of our GDP. This doesn't ever happen in peacetime ever, either. I'm sorry. And, but it's, again, people have been talking about it now, both sides of the aisle, as it being crisis and being something that has to be resolved. But one side of the aisle, quite frankly, the Democrats don't seem to really have any solutions for getting the deficit down and aren't even really, trying. But we do number three, we have an administration now that is cutting federal spending as fast as Congress and the courts will allow. And the implications for that are great if we want to reduce the deficit and ultimately maybe pay off the debt, or at least not have it grow so fast. But it also has huge implications for GDP when you're cutting the size of the federal government. A lot of people make their living off of being employees or being contractors or supplying the federal government. Number four, we are reducing our population by sending immigrants home in a complete reversal of record amounts of immigration over the past 4 years. This obviously impacts total economic activity, and it also reduces the workforce. So this is a big, big deal, and we haven't really done something like this very often in history. We did back again, just before I was born in the 30s. Number five, we are at the very beginning of a demographic cliff where 18-year-olds will numerically drop every year for the next 5 years. Not by small amounts, by big amounts. By such big amounts that colleges, universities, et cetera, are very concerned, and it will have an impact on the overall number of available people to be going into the workforce. Number six, President Trump has completely and totally upended the international economic system, mostly in the area of trade, through the use of tariffs, which he did a little bit of in his first term, but which basically you got to go back to 1912 to be able to even talk about tariffs. Anyway, it's the upending is to such a degree that it's hard to know at all what the ultimate result will be in terms of how things balance out again, because they will, but it might, sometimes there's going to be some harsh results in the meantime, but so far, not so much. Number 7, the U.S. is working feverishly to reshore, onshore economic and military strategic mining, refining, and manufacturing. And we're doing this at a breakneck pace. So, and this is huge in terms of the impact on the economy. The U.S. has 22 of the largest 25 companies on the planet, and most of the biggest are in the AI business. And they are building out data centers right now in the biggest and fastest infrastructure effort ever in history. Not even close. As far as we know, nothing like this. Not building out the railroads, not building out the highways, not building out, the electric lines, if you will. No, this is the biggest, fastest infrastructure effort in history. Now, you could think maybe back to World War II and what the U.S. had to do to get their manufacturing up to fight the Second World War. And that was pretty impressive. I think this is bigger. I think it's faster. Number 9, AI is changing business in a way similar to other automation like electricity, phones, computers, the internet, cell phones. But most pundits, including me, believe that the impact will be greater than any of those, bigger than any of them. Number 10, while there may be transitional pain, almost everybody thinks that GDP growth will bring wealth like never before, as essential needs become a very low cost of our daily budget. This has been happening now for 150 years. This is not unprecedented. We've seen lots of things that used to cost a lot of money that are now free. Oh, phones, for instance. I could go down the list. If you watch this show often, you know I've talked about this many, many times. There's a whole bunch of stuff right now that we do that used to be expensive that is now very inexpensive as a comparison on our budget. Maybe not in actual dollars, but in terms of the percentage of our budget. But this is going to happen bigger, and it's going to be faster, and it's going to bring millions of people out of poverty, as well as bring people who are right at the poverty level up to middle-class standards. Number 11, our young people aren't dating. They're not having sex. They're not getting married, and they're not having kids. This is a worldwide phenomenon, and it has massive implications, as Elon Musk has been the one who famously kind of got the ball rolling on this. Other people have been shouting about it, as I have, for 25 years. But it is a thing, and now we have to really start thinking about how do we deal with it. Number 12, the cost of housing is creating unrest and anxiety. So the cost of housing is high. I've been talking the last couple of weeks about how, gee whiz, come on, get over it. You can find a way to buy a house. But the truth is it's very high, and people who are not clever enough to figure out how to solve their problem look at it and just go, you boomers, or Trump, it's your fault. Anyway, it's a serious issue, and people are very angry about it. Number 13, we are about to start the greatest generational wealth transfer in history. And it's not even close to previous decades. This is going to be massive. And some of these people that can't figure out how to buy a house, grandma or daddy or somebody is going to be handing it off, and you'll have plenty of money to buy that house. I think that's going to happen in my family. Number 14, the population is skewed so much with old folks. They have all the wealth. And that is impacting the way investments are being made, because people that are over 55, over 65, over 75 invest completely differently. They spend completely differently. So it's impacting the GDP, it's impacting the way that the economy runs, and it's impacting the way that people invest. And then number 15, which I'm adding right now, ad hoc, because I left it out, we're doing a build out of energy. Now it's part of the AI build out, but we needed the energy build out anyway because of electric cars and electrification of our homes. This build out is, again, an infrastructure build out of unparalleled there's nothing to compare. In fact, it's needed. The need is much greater than the even potential, even the possibility, unless we figure out some ways to reduce that need and or faster ways to get the energy to market. So it's a big problem. It's a big issue. I don't think it's going to slow us down very much, but it is part of these 15 things, any one of which could be earth-shattering in terms of the change, could cause disruption, could cause problems. But no, all 15 of these are happening simultaneously. Well, while every one of these have some positive elements, the fact that we're dealing with the outcomes of all of them at once creates unknowns at historic levels. If we bring the issue down to right this minute, we currently have, are you ready now? We currently have these situations right now in terms of markets. Number one, gold and silver blowing out all-time highs. Sure, they came down a little bit over the last couple of days, but they're coming down from nutty increases in the last 2 weeks. I mean, we had nutty increases in the last 2 weeks. We're not even back down to where we were 2 weeks ago after the big blowout on Thursday and Friday. This newish phenomena called Bitcoin. So Bitcoin is creating the fastest growing asset ever. And it's continuing to grow exponentially. And we don't know. There's not just Bitcoin, there's Ethereum and others. And we don't know the impact, but it's growing like crazy. So in other words, in terms of asset classes, we got gold and silver at all-time highs. We've got Bitcoin and all those at all-time highs. The equity markets are hitting all-time highs and nearing 20% increase for the third year in a row, which rarely happens. Way over 20% in 2023, way over 20% in 2024. And now it looks like we could hit 20% again or close to it in 2025. And number of all-time highs so far this year, I've lost count. I think it's over 40, something like that. And it looks like we'll have more all-time highs if Tom Lee and I are right. Tom Lee says we're going to 7,000. I say we're going to 7,100. We'll see what's going to happen. Number 5, oil is crashing. And that, Mr. Trump will be taking a victory lap and saying, I did it. And somebody cleverly said, I forget who it was, darn it, I wish I could say, that Trump will probably start refilling the strategic reserve to pull the prices back up into the low 60s so that we don't start capping oil wells. Number 6, I'm sure that I've left something out. Some kind of other superlative or record situation that we're dealing with right now in terms of asset classes. One thing I know is that the bond markets still are oversold. The rally hasn't really come yet. Well, the rally's not bad, but we could have a much, much more substantial rally in bonds. But as far as asset classes go, it is undervalued at this point. So it might not be shocking that some are quite concerned. Some are quite concerned that there's a bubble or maybe several bubbles, and that when they burst, markets might drop 50% or more. So you've got these various asset bubbles, housing, which could burst. We've seen that before. We've got gold. You've seen what gold has done in the past when it's had some of these run-ups, and silver is running up faster than gold. And it could have an impact. And you've got Bitcoin, which we've seen it drop 50%. So that could happen. Then we've got the asset build out in terms of energy and AI storage. Maybe they're overbuilding, and maybe we'll wake up 2 years from now and go, oh my gosh, we don't really need all this AI, or maybe we don't. And because of that, we don't need all this energy, or we figured out ways to do it in such a way we don't need as much energy. And we might see some companies get caught in that. And almost certainly at some point, there will be companies, as there always are, who get caught in some of these economic situations. Well, in terms of the equity markets, the S&P, the NASDAQ, the Dow Jones, even a typical pullback of 10% would alarm many. I think we should get it. I think it'd be great. I think it'd be positive. But a 20% bear market might cause panic, even though we had that flash bear market earlier this year, and we all survived. For Tesla shareholders, these pullbacks are likely to contain a much bigger hit. And, we're kind of used to 50% dips. That's just kind of normal for us, but we don't want it. I mean, we're sitting at 440 right now. We don't want to go back to 220, but It wouldn't be the biggest shock ever. Maybe we will, maybe we won't. Meanwhile, as I pointed it out in a must-see video from yesterday, if you didn't already see it, the U.S. corporate world is now doing fine. The earnings increases are record-setting. Borrowing one paragraph from that video yesterday, the blended year-over-year EPS growth rate, which combines the actual reported earnings from the companies that have already disclosed results, I think it's 55 companies, with those yet to report, is currently estimated to be 8.5 to 9.3 for the full S&P. And if you take out the energy sector, which right now, obviously with oil prices being down, is dragging down the overall figures, then you get the estimate rises to 10.1. And many people are saying it's probably going to end up more like 12 to 13% annualized when we're done with earnings season. Tom Lee, who I just mentioned a minute ago, says we could have a pullback, but it would be constructive, and that we're headed towards 7,000, as I mentioned a minute ago. But others are very, very worried. And the thing that got me started to put together this little essay was Market Watch. And they did this article. Well, they did this article. Brett Ahrens did this article. He says, are we in the dumbest stock market in history? He says it's even worse than you might have imagined. Missing out isn't the only thing to fear. FOMO is not the only thing to fear. Is the current market truly the dumbest stock market in history? According to Brett Ahrens, it is worse, far worse. A groundbreaking B of A Securities Global Fund Managers survey reveals a record 60% of top investors, 60%, managing $400 billion across 166 funds, view global equities as overvalued. Shockingly, 54% label the AI boom as a full-blown bubble. Yet these same professionals remain heavily overweight in stocks, chasing volatile sectors like emerging markets and banks while skimping on cash and treasuries. As mentioned, this contradiction screams irrationality. Despite spotting the dangers, fund managers plow ahead. Gripped by FOMO, no one wants to bail early and risk their job amid the herd's momentum. Ahrens likens it to a bull market ending not in euphoria, but peak fear, fear of losing at bottoms, fear of missing gains at tops. Echoing the dot-com era, the survey signals bear capitulation. In 1999 to 2000, holdouts capitulated or got ousted, fueling the frenzy. Today feels very similar. The S&P's 500 Shiller PE ratio has hit 40, double the historic norm and unseen since 1999. Just recently, a holdout NVIDIA skeptic flipped to a buy rating, embodying the adage, the bubble peaks when the last bear turns bullish. For everyday investors, eyeing an exit, pitfalls abound. First, no crystal ball. Stocks could double. They could double down to the Shiller PEA and go to 80. This time is different. That's what some people will say. Oh, no, it's completely different. It is completely different, but I just gave you all the reasons. You can disagree with me, but I gave you a whole bunch of reasons why it is different. Does that mean I think it goes to 80? No, 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 no. Do I think that it means that 40 might be okay? Maybe. Second thing's impossible. Not going to go to 40, not to go to 80. Warren Buffett's .com quip rings true like Cinderella sans clocks. You sense midnight's near, but can't pinpoint it. You're looking for the exact top. It's not going to happen. Ahrens urges caution. Scrutinize risk in retirement portfolios now. Rebalance to prevent equity targets. The survey spotlights unloved assets like bonds. They say they're underweight by 24%, the lowest since 2022's bond bottom. Cash, energy, and UK stocks. Cash, energy, and UK stocks. I wouldn't put any money in UK stocks if it was the only available thing to put money into. I would say in cash before I would buy UK stocks. That country is in serious trouble from the top to the bottom. These are all prime capitulation signals, it says. So the cash, energy, and UK stocks is where you need to put your money, apparently. Bonds stand out as a contrarian play. Managers shun them, fearing insolvent governments will spark inflation and rate spikes. Yet Japan, with steeper debt than the US, defies this via deflation and low yields. And of course, you know that I think deflation is coming, but it's the good kind of deflation. What's a good kind of deflation? That's the deflation. I always use the example like this giant television I have over here. 2 years ago, my old one broke. I needed to go out and get another one. I was expecting to pay $1,200. It was $799 for a better TV. That's good deflation. So right now, we could have quantitative easing again if we needed stimulation, and that would be bullish for bonds, but I'm not worried about any of that. What I think the bond market is going to do is it's going to see deflation, or it's actually going to see inflation dropping below 2%, and it's slowly but surely going to drop down into the threes. Enter Hoisington. Easy for me to say. Enter 𝐒𝐮𝐬𝐽 Investment Management. The outlier is betting on long-term treasuries. They foresee a sharp U.S. slowdown. Me too. No, not. Wall Street overlooks plus AI's dark side. Massive job losses in the call centers, data entry, and mid-skill roles. One AI worker replaces many, slashing labor demand, wages, and hiring, stoking recessionary pressures and favoring bonds. If AI flops, those sky-high stocks look even more unhinged. Okay, so here's one of the problems, the number one problem with this entire article. If AI is super successful and there's lots of job loss because of AI, that means productivity is going up. Okay, if productivity is going up, prices are going down for good things, for television reasons. Prices are going down because they're just less expensive to make. And that's a good thing. All right. So if you got job losses because of AI, productivity up, wealth has to go somewhere. It's either going to end up in earnings or it's going to end up in lower prices. So wealth is a good thing. Now then, if it goes the other way, you can't have both. All right. It's unlikely to have both. If you have AI flops, it doesn't work. Well, then you might have some problems with NVIDIA stock or, other stocks that are AI heavy. But then you've got too many workers. Too many workers, not enough workers for too many jobs. And so wages will go up, and so the folks will get rich. Now, the Trump administration's plan is to have both of those things happen simultaneously. I'll explain that in a minute. In sum, the article says, this market's folly transcends dumb. It's a fear-fueled farce. Easy for me to say. It's a fear-fueled farce where pros know better, but they just play along. Investors, they dial back risk, eye the sidelines, and ponder unloved havens like bonds before hindsight bites. And by the way, that was written by Grok. You can kind of tell, right? I'm not an investment advisor. This is now me speaking. By the way, I'm Randy Kirk, just so you know. I'm not an investment advisor. And none of what I just said or what I'm going to say is investment advice. Fortunately, I'm not an economist either. So I'm not hemmed in by ancient formulas that no longer apply to these extremely unusual times. I am a lifelong investor since I was 18, 19 years old. I am a lifelong entrepreneur, having started multiple dozens of companies, and 20 or so of those companies actually paid my mortgage for a time. One of them ended up being $5 million in sales with 100 employees in the manufacturing sector. So I've been doing this for a long time, and I'm really old. So theoretically, there's wisdom in that. I don't know for sure, but you make the judgment. So here's my take. I don't know. You don't know. That's my take. I don't know. You don't know. Trump, Besson, they don't know, but I do trust their judgment. Trump doesn't know, and while I think his instincts are Musk-like, he's also a risk taker, and sometimes things just don't go as expected. And Besson, he's more conservative, more calm than Trump, but I think I really trust his instincts also. The markets This is my favorite. The markets, to me, are a voting machine at times and a weighing machine at other times, but combined together, the markets are the best ever crowdsourcing method of seeing the future in history ever. There's just nothing better. People putting their money, putting their hard-earned cash, putting their reserves, putting their savings into the stock market and saying, I'm betting that this is the way the stock market. These people have done, some of them have done a lot of research, some have done a little. And the people overall are making bets of their own money. And all together, when you put it all together, that's crowdsourcing. And that is, I think, an extremely good way to understand the future. The equity markets right now are saying that we have 6 to 9 months of smooth sailing. The bond markets have been cautious, but they're now seeming like they're going to join the party. Gold is likely an outlier, but that is specific to international conditions like the Chinese buying up massive amounts of gold, but also a current FOMO top. Saw pictures yesterday of people lining up outside of, I don't know, some places that are selling gold, and people are trying to get in on the deal, trying to buy gold cheap because they think it's going to go much, much higher. That never ends well. I've already made my prediction. You've already heard it. I continue to believe that a 10% pullback would be a good thing. I'm not sure we're going to get one. I'm sure we'll have 2.5 and 5 based on news. I also believe that the next 2 years are going to be bonkers, 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 as the economic benefits of the AI revolution impact, and the job side is not yet an issue. But it's also going to be because of tariffs bringing down our deficit, ultimately maybe creating a surplus and reducing our debt. That is going to help bonds come down even more. That is going to help the deficits come down even more. We've got this virtuous circle taking place. The whole thing with AI and energy is going to be huge. What Tesla is doing, of course, with Optimus and with robotaxis. I mean, these are massive, massive, massive changes, and all of them are positive. Wait, you say, how could all of that be? All right, what is the job situation? This is the one that everybody seems to be the most worried about. So you gotta think it through. Let me know if you think this is logical. We're going to have fewer 18-year-olds. That means fewer people coming into the workforce. So even if we have fewer jobs available for the entrance, the low-skilled beginning entry-level folks, we're going to have hundreds of thousands fewer people coming into that area. We also have no immigrant labor being added. As you know, for the last 5 years, we've had immigration coming in like crazy. We actually 4 of the last 5 years. But now for the last year, the immigrants are going home. So that's going to reduce the number of people for those entry-level jobs as well. We have a massive infrastructure build, and it's going to take a lot of folks to build that infrastructure. We have that massive energy build out, which is going to take a lot of people to build that energy build out. I think with the interest rates coming down, we're going to have an improvement in home building. And then you're going to also have an increase in people buying used homes. And when they buy a used home, what do? They got to fix it up. That means we'll have durables rebounding finally. And that, of course, and then add to all of that the $18 trillion of manufacturing, what do you want to call it, cash coming in from these countries, these pledges they've made in order to help all this that we just talked about. That's going to create, and then the onshoring of manufacturing, creating manufacturing jobs. I think there's going to be plenty of jobs. Even if AI creates a reduction, I think we're going to have plenty of jobs for the folks that are still here. Now, employees are going to need to be nimble because there's going to be different jobs. But if they're ready to try something new, I think there's a greater chance of a labor shortage in 2026 than significant unemployment. So I do think there's a chance we could maybe bump up a couple of points, 4.4, 4.5, maybe even 5, and then go the other way, maybe down to 4%. 2028, what's going to happen? So 2026, 2027, they're going to be amazing. What about 2028? Too far out. The likelihood seems high right now that the golden age or the age of abundance will be going great by 2028. But so many unknowns. like the 14 I mentioned up above. Hard to know. Maybe there will eventually be too much energy. Maybe there will eventually be, too much AI data center build out. We don't know. Maybe we will really have a shortage of labor. I mean, a serious shortage of labor. That's the one that I am most concerned about, quite frankly, is really a shortage of labor. We saw what that did a couple of years ago. So now, as noted, you may want to go back. If you want to finish this story, go back to yesterday. I'll put the card right up here and see the video that I did yesterday about the overall earnings season that we're in right now and the impact that earnings season is likely to have on the S&P and the other equity markets. Coming up later today, as far as I know, we will have the Monday morning show, which is, of course, on Sunday night. And that show is now getting every week, maybe bigger numbers. I'm really pleased with how many people now are joining me for that show because it is very, very important. I lay out the day's news from Tesla, then I lay out the day's news from the economy, and then I talk about all the things that are going to be coming up in terms of earnings, what's going to be happening in terms of markets, what's going to be happening in terms of economic indicators, and then I also talk about where I think maybe Tesla might be going. And this week's a pretty big week for that because we do have Tesla earnings on Wednesday. By the way, the book is by the way, the finished book is in my inbox. I need to do one last check through, but I think we're going to be able to start taking pre-orders by Tuesday or Wednesday. Excited I am. This has been fun. This is going to be a great book. You're going to love it. Okay, I'm looking forward. I'm expecting, and you guys need to buy this book. All right, this has been Randy Kirk. It has been great talking to you. Let me know in the comments below what you thought.